You're probably wondering where the funky beat is. It's coming. I just wanted to let you know that, first of all, we are so grateful for every one of you. Thank you so much. Over 2,000 listeners. This has been amazing, and an incredible journey to be on with all of you. And I hope that you're all taking some action. Not I hope, I know you are. I'm hearing about it. I'm seeing it on Twitter. I'm seeing it on Instagram. So everyone just keep it up. Keep it up. So this is not season 2. This is a bonus episode. Yay, bonus episode. So in this episode, we have our summer FinLit series, which is an incredible series we did over the summer, online financial literacy. It was amazing. I'll let it speak for itself. We're going to dive into it here. Just make sure you subscribe so that you are the first to know when season 2 drops. It's coming at the end of September. I miss all of you. Looking forward to engage. Okay, now we can let the beat drop.
Good morning, everyone. It is a wonderful hot day in Texas. It will probably be over 100 today, so that's exciting. And I have a long sleeve shirt on, so I had to step away for a second and turn the air up a bit. I'm excited today to continue our financial FinLit 101 series. Last week, we talked about, just laid the foundation and talked about some of the core principles of financial literacy. Today, we're going to take 2 of those components a little bit deeper and learn more about things you can be doing now to help get yourself in a better financial position so that you can reach more of your financial goals. So I'm going to speak for about 20 minutes. I do want to leave plenty of time for questions. I'll go through the slideshow here and really just feel, like I said, just try it. We want to have some fun here. At the same time, I want to make sure it's informative and giving you things that you can go and do now, things you can go and take advantage of now to try to get in a better financial situation. So with that, let me share my screen and we will dive all the way in. All right, and then it puts everybody on that screen. Give me a second. Let's see, move that over there and move you because you know what you look like already. All right, so diving in. So as Alicia mentioned, we are a financial planning company. We help people make better financial decisions. The best way I can describe it is think of it like the GPS that's in your phone. If I were to say, meet me at a restaurant, you've never heard of that restaurant, the first thing you're going to do is go to your phone and type it into Google Maps. Okay. But Google Maps or whatever map app you're going to use, Apple Maps, what have you, Waze, it's going to ask you a very important question because before it can tell you how to get to where you're going, it needs to first know where you are. And it's going to say, can I have your location? And GPS is so powerful. It's down to 10 meters. Within 10 meters, it knows exactly where you are. And then it will map, it will give you a map, it will give you a plot to say, here's how you get to that restaurant. Now, of course, on the way, you could encounter traffic, the weather could change, you could forget something and have to go back home, but nonetheless, it's going to keep rerouting you to help you get to that place. Financial planning is the same. It's about creating a financial GPS. We all have goals of where we want to go. This is creating a roadmap to say, here's what's going to take to get you to your goals. And here's how you can protect yourself along the way. Like when we get in our car, we wear our seatbelts. You probably use your turn signal. You make sure it has gas. Same thing comes to our financial goals. For those of us that have children to want to educate them, there's things that we need to do along the way to make sure that we are able to keep putting money away so that we can educate them. So that's kind of an analogy of what financial planning is. But with that, let's get into financial literacy. So number 1, we want to keep things simple, okay? You, your spouse, the people you love, as adults, we earn money. It's just what we do. We do something so that we can earn money. And typically we want that money that we want it to grow. We want it to be more money. And we want to protect our money. We want to make sure that money is there when we need it. And then more often than not, at some point, we want to make sure we have an efficient plan to transfer our wealth to the next generation. Okay. So that's really what financial planning is all about, is just doing those simple things. Okay. But of course, as we lift up the hood, it can get a little bit more cumbersome and difficult than that. And we'll talk about some of those areas. So the journey of financial literacy, we talked about this last time. The first thing to figure out is, what are your values? What's important to you? Is educating children important? Is buying a home important? Is having a cash reserve important? Is being able to have financial independence? And figure out what's important from a values perspective. What are the decisions that you want to be able to make? And then you got to do some research on your options, which is how you ended up here. You started researching, like, okay, how can I learn how to do better with my finances? Okay. Once we start researching those options, then you're going to have to get some education. You're going to have to learn, okay, what is an IRA? What's a Roth IRA? What's a 529? And you'll probably need to ask for help. Okay. Quick story about help. The day was July 3rd, 2020. It was 100 degrees outside. I'm standing under the air conditioning and I'm like, I don't feel anything. Sure enough, our AC, it went out. Okay. So first of all, I value being comfortable with my house, so I want AC. I started researching my options. I came into the attic. I'm looking at the AC machine. Don't really know what I'm looking at, but I was like, wait, there's a few things I know how to do. Let me try changing the filter. And this was right after we had that huge dust storm. Filters were dirty. I changed them out, put them back in. And then I started doing some research online. If your fan's not on, how to turn your fan on. I called my brother. I asked for help. He's the AC specialist. He told me a few things to do. Guess what? The fan came back on, but now it was creating hot air. So I had to ask for more help. I had to call an AC specialist, and he gave me a plan, though that plan said we can't come till Monday. I was like, wait, we have to go July 4th weekend in the heat? And that's what we did. We just sat very still. But ultimately, he came on Monday, and he fixed our AC, and we were able to take action, and now it's back to being cool in our house again. Okay, this process, we use the same process for almost everything that we're trying to do. We apply the same to finances. What's important? Look for options, educate yourself, get some help, come up with a plan, and then, of course, take action. Okay, and know that your financial literacy journey is a lifelong process. You're not going to learn everything in 30 minutes on a Saturday morning, nor if you did this every single Saturday from here to eternity. The more you know, the more there is for you to learn about how to better manage your finances. Okay. So once you understand your values, we got to create some financial goals. So many people have very different financial goals, but one of the things that I have learned is that no matter who you are, we all have a financial goal of reaching financial independence. Okay. What that means is that we all at some point want to have enough money that work becomes optional. Okay, whether that's money just sitting in an account somewhere, or that's income coming from rental properties, or income coming from other investments that we made, we want to have enough so that we can be financially independent. Okay, and to be financially independent is something that not a lot of Americans can do. Okay, most Americans, more than half of us, when we reach retirement, we are dependent on either someone or a government entity, meaning Social Security or something like that, just to make ends meet. Okay. Our role on this planet is to help people not to have to rely on somebody else or rely on the government, and just rely on yourself and the work that you did and the money you saved over the years. Okay. So, getting back to last week, we talked about the foundation, the financial roots of financial planning. They break into 4 basic areas: understanding your cash and liabilities, the money you have and the people you owe; protection, which is a fancy word for insurance. Okay, having the right amounts and types of insurance, whether it's auto insurance, health insurance, life insurance. We're going to talk about a few of those today. Growing your money through fixed and equity assets. Those are your 401ks, your IRAs. Your house is an equity asset if you own a home. And then taxes and estate planning. Okay, tax and estate planning can be very complicated. And a lot of times we have to turn to professionals. Even with as much as I know, right now, my computer is sitting on a book that's about 3 inches thick called the 2006 edition of Comprehensive Volume of Taxation. Yeah, I read the book. I took the course. I still hire a CPA. Okay. Because sometimes I'm living in it. So sometimes I don't know what I don't know, and I'd rather have an expert. So taxes and estate planning, we hired an attorney to do our estate plan. Okay, because those are the experts. They know a lot more than any course in LegalZoom could teach me. Though I do know enough to be dangerous. I know enough to tell people where they have gaps, but still we go to the experts for some of those things. Okay, so today we're going to dig into cash and liabilities and protection. So let's start with cash and liabilities. On a core level, cash and liabilities is built off of our cash flow and budgeting. So I'm going to go through 5 quick steps on how to review or create a budget if you've never created one before. So number 1, determine all your sources of income, okay? And you want to do this with either a blank piece of paper in front of you, or a blank Excel sheet, or numbers, or Google Sheets, whatever you use, that if you know how to use those tools, so that you can start putting some of this information in. Now, Numbers, which is on Google, Excel, which is a Microsoft product, not Numbers, I'm sorry, Sheets, which is on Google, Numbers, which is the Apple product of Excel, and Excel, which is the Microsoft product. All of them have budgeting tools already built into the templates, okay? And they have more than one, and they're very easy to use. If you're someone that gets intimidated by Excel or Numbers or any of that, I encourage you, just go to YouTube, okay? There are YouTube videos that people have made on how to use those budgeting sheets. They're actually fairly easy to use. So, but once whether you want to do it on paper or you do it on a computer, the first thing is determine your sources of income. Okay, do you get paid on a monthly basis, a bi-weekly basis, a weekly basis, a daily basis? Determine what is your income, okay? And all sources of income, your spouse's income, any money you may have coming from other investments. And then you want to research your last 90 days of expenses from all sources. I should have capitalized all sources, okay? It is very often I talk to people that come to do financial planning, and I say, hey, how much do you spend on a monthly basis? And they'll say, oh, $4,000 a month. But what they didn't count were the other expenses that maybe go on a credit card, or the expenses that may come out of PayPal, or the expenses that may be Venmo, or all those other fun places, Apple Pay, those places that make it easier for us to move our money, but sometimes we don't keep up with what those expenses are. So you want to make sure you know what your expenses are from all sources. Where is your money going? And then you want to categorize those. Okay, so you want to put them into, is this a housing expense? Is this a clothing expense? Is this food? And most of those programs, or excuse me, those applications will give you some categories to get you started, but you want to categorize everything over the last 90 days. And then from that information, create a spending plan for the next 90 days. So let's say you look back and you're looking at everything, you see that on average, your household spends $4,000 a month, okay, on going to everything. Well, now you can create a spending plan, okay, for the next 90 days, we want to stay within $4,000 a month. Or maybe you look at it and you say, whoa, it's $5,000 a month, and a lot of that was going to stuff that's discretionary, things that you have a lot of choices over. Maybe it was eating out. Maybe it was, coffee, but not the kind you make downstairs, the kind you go and get from Starbucks. Maybe that costs you money. But whatever it is, you can then make a plan to say, okay, this is how much we want to spend, or I want to spend over the next 90 days. And from there, your role is just to track what's coming in and track what's going out, and make the necessary adjustments to the budget. It's not going to be perfect every single time. And sometimes things are going to happen, or things will pop up. It's like, oh crap, I forgot. It's auto insurance. We have to pay our 6-month auto insurance premium or something like that. And maybe that wasn't built into your budget, but you know how to fit that in next time so that expense doesn't scare you, okay? Cash flow and budgeting are the basis for any financial plan. Businesses do cash flow and budgeting on a monthly basis. From your largest business, think of like a Starbucks, all the way down to the person that owns the coffee shop, okay? They all do this cash flow and budgeting work. You got to do it in your household too, okay? Or else you're going to continue to be surprised by expenses, and you're going to continue to not have a handle on how much you can save. And that's really what you want to determine from this process is, how much am I able to save? What is left over, and what am I doing with that money to help it in other areas of my finances, or possibly use it to pay down some debt, okay? Now, once you know what's left over and how much you're spending, the goal is to create a cash reserve. I cannot stress how important a cash reserve is, okay? It provides you with the money you need for emergencies or opportunities. We recommend, and most professionals recommend as well, to have a reserve of at least 3 months of your expenses. Now, some people may want to have a little bit more. They're more comfortable having more cash. But going back to my example before, if your family spends on average $4,000 a month, you should probably have a $12,000 cash reserve. 4,000 times 3 is 12. Okay. And what that will provide you with is that if for some reason your sources of income stop, you know that you can pay your bills for the next 3 months. Okay. Now, some of my clients, or our clients, excuse me, have larger cash reserves. Some have 6 months, some have 9, some have an entire year. Okay. But everybody's different as far as where their comfort level is. So whatever you decide your cash reserve goal is, and it's okay if you're starting with just building a 1 month reserve. Let's say your expenses are 4,000 a month, but right now in your bank account is only $1,000. Well, your first goal is to have 1 month of all your expenses in an account. Okay. So if you have an emergency, you can rely on that, because if you don't have a reserve, you will have to either borrow, okay, or go without. And there's some things you probably don't want to go without. Okay. For those of us with children, which I think is, from so far, most of us on the call, except for Aaron, for those of us with kids, if our kids are hungry and we need to feed them and there's no money in the bank account, we will swipe a credit card. Kids got to eat. Okay. Or we will call someone else and say, hey, we need to borrow some money. Our children have to eat. So having a cash reserve will help prevent some of those things from happening, will help reduce the likelihood of you having to use debt or borrow from someone else. So whatever your cash reserve goal is, make sure you set a SMART goal. Okay. Many of you have probably heard of SMART before. It stands for specific, measurable, actionable, realistic, and timely. One more time: specific, measurable, actionable, realistic, and timely cash reserve goal. So let me give you two different goals that I've heard from clients. One client will say, yeah, I want to save up $10,000. Okay, that's a pretty good goal. But is that a SMART goal? Is it specific? Kinda. Is it measurable? Yeah, $10,000, you can measure that. Is it actionable? It hasn't talked about any action yet. Is it realistic? I don't know. Depends on that person's situation. Is it timely? Absolutely not, because all they said is, I want to save $10,000. A SMART goal would be, I want to save $10,000 for my cash reserve. I want to save it into my savings account. I want it to happen within the next 12 months, or even better for timely, I want it to happen by July of 2021. Okay. And the action I'm going to take is by putting $300 out of every paycheck into my savings account. Now we have a SMART goal. Okay. You're more likely to achieve your SMART goals than you are to say, oh, I'm going to save up $10,000. Okay. So we want to make sure you have a SMART cash reserve goal. And then the last tip is, consider keeping your reserve in an account that's less accessible than your checking account. Okay. We're human. Sometimes the desire to do things can be more powerful than the desire to delay, meaning that immediate gratification. There's a joke, some of you may be familiar with Kevin Hart. There's a joke that he had a long time ago, one of the stand-ups, when he was out, he said he was out with some ball players or something, and they were in the club, and they're like, hey, let's, throw some money around, whatever. And he's like, so, I'm not as rich as you guys. I have 2 accounts. I have a checking and a savings, and it takes 2 days for the money to get from my savings account to their checking account. He was making a joke, but that's what some people need. They need their money not to be accessible, on a Saturday night while they're at the casino, or else they're going to take that money out and think that they can continue winning. Instead, it's somewhere that takes them a couple of days to get to it. So that's just a consideration to take when you're building a cash reserve. Okay. Moving on to debt management. Last week, I shared this with you. I'm going to go over it really quick. If you had 2 credit cards, each for $1,500, both at 18%, whereas one you paid $30 a month and the other you paid $50 a month, well, that extra $20 could save you over $700 in interest. So you pay $1,200 in interest here, paying $30 a month. You pay $500 in interest here, paying $50 a month. And this one would take you 93 months to pay off, and this one would take 40. Okay. I mentioned that this week we would take that up a notch and talk about when you own a home and the interest that's associated with that. Okay. So right now, interest rates are at all-time lows for home loans. They have never been lower than they are today. Okay. So I wanted to walk through 2 quick examples on a $250,000 loan, $250,000 home. Okay. And I know, Bree, that's probably unheard of in California. but just work with me on this. You can just double or triple everything and the numbers will still work out. So if you had a $250,000 home that you were looking to purchase and you put a 5% down payment, your down payment would be $12,500. Now, this doesn't include closing costs and all this stuff. We're just dealing with the home and the down payment and the bank and the loan. A year ago or 2 years ago, your interest rate would have been 5%. You would have had that term for 30 years. The monthly payment on that note would be $1,275 a month, not including taxes and insurance or anything like that, but just for the loan. The total interest, if you stayed in that loan for 30 years, the total interest you would pay is $221,000, meaning your total you spend on that home is $471,000. So you buy it for $250,000. It costs you $471,000. Yes, almost twice as much money you pay for the home. But today, rates are down to about 3.5% for the same loan. So if you're buying that house today, $250,000, same 12.5, 3.5%, notice the payment is almost $200 less, a little more than $200 less. And the total interest is $70,000 less, okay? That's significant, 75,000 to be exact. And the total payments are 396, okay? The reason I'm sharing this with you today is that, one, if you have a goal to buy a home, it is very advantageous for you to make that happen sooner rather than later because rates are so low. Okay, now I know you have to get a lot of other ducks in a row to make it happen, but just think because interest rates are low, you have a unique opportunity right now, okay? Also, I wanted to share this with you for any of you that are home owners. If you haven't looked at refinancing your home, do it today, okay? Call up your lender, send us an email, whatever it is, we have a relationship with lenders. Let's see if it makes sense for you to refinance your home now because you can probably get a better rate. Alicia and I are going through a refinance right now, okay? We're going from 5.25 down to 3.5. How much were we saving, babe? I forgot. Was it $600 a month? Our payment's gonna drop?
$600 a month, yes.
Our payment's gonna drop by $600. Now, I know our teenage son is not on this call this morning, but that's enough for a car payment. We're not gonna buy him a car with it, but $600 is a lot of money, okay? I don't care who you are, $600 is a lot of money, okay? So if you, and this isn't just for home loans. If you have student loans, if you have credit card debt, if you've borrowed any sort of money, if you owe anyone any money and it's at an interest rate and you borrowed that money more than 6 months ago, there is a very high likelihood that you can get a better rate on that money today, okay? And if you get a better rate, that means less money goes to interest, which is more money that you can keep, okay? Moving on. So let's go into protection. So we talked about some cash, we talked about liabilities. We want to go into protection. And one of the worst things that can happen to us as individuals is that we die prematurely. And when we die, there's one of two things are left behind. Either we leave behind assets or we leave behind debt, okay? Our role as financial planners is to make sure that you're leaving behind as many assets as possible and as little debt. So I wanted to talk really briefly about how life insurance works. Now, of course, life insurance is a contract that says if you die, money gets paid out to someone, okay? Now, with all life insurance policies, we have this wonderful thing known as the actuary curve, okay? So along the bottom, we have your age. So as you get older, guess what? The chances of dying increase. At some point, death is pretty much inevitable. It's going to happen, okay? Well, it's going to happen to all of us at some point in time, okay? So as we get older, the likelihood of dying increases. Well, that also represents the cost of insurance. The older you get, the more you're going to pay for life insurance, okay? So chance of death, cost of insurance are correlated, okay? Now, the simplest form of life insurance that you can have is known as term. With term insurance, you're going to buy it at a certain age, or whatever age you are, and you get to lock in that term for a specific amount of time, 5, 10, 15, 20, 25, or 30 years, okay? And you'll pay that premium all that time. And essentially what you're saying with term insurance policy is, hey, insurance company, I bet you I'm going to die in 20 years. Insurance company says, you probably won't. So they're going to charge you a very low premium and say, yeah, we don't think you're going to die. And the truth is 98% of people that buy a term insurance policy waste all their money, meaning they live. That's okay to waste money if you lived, okay? But if they die, then of course it pays out, but it doesn't happen often. If you wanted to keep that term insurance, after the term ends, they're going to go back to the table and they're going to rate you again based on your new age. And that is going to be an increase in premium. It's going to cost you more to get another policy. Alicia and I just went through this a few years ago, okay? Because our son is 17, or was 17 at the time, that our daughter was being born. Well, our term insurance wasn't going to do any good for our daughter that's just being born. So we had to go out and get new policies. Okay. And I was paying a lot more for the new term insurance than what I paid for the one that I got when I was 22. Okay. Now, that's term insurance. It's also whole life insurance. Okay. And with whole life insurance, you're going to pay a higher amount, but it's set for your whole life. Okay. It's this whole life and universal life insurance. And those work a little bit differently. They have some other perks and benefits that come along with them, but it is a type of policy that you can have that lasts forever. Alicia and I both have whole life insurance policies as well. We have both. We have whole life insurance and term, okay? Because we know that that term will end at a certain point. And we basically said, hey, insurance company, I bet we're going to die. Insurance company said, nah, you probably won't. And I hope we don't, okay? But that is the basics of how life insurance works, okay? Now, another question asked is, how much life insurance do you need? Okay. And the amount of life insurance you need is different for every person, but there's a quick exercise you can do to figure out how much. Okay. One side of the equation is the minimum amount you would need. And for the minimum, you just add up all of your liabilities, any goals you have. So in this scenario, I said kids' college, you want to pay for kids' college, the cost of burial or cremation, whatever it is you want to do, and any gifts you want to do to charity. So in this scenario, we said $500,000. So what this is saying is that for this family, that each of the parents should have at least $500,000, and that would cover these minimum things. Another way to calculate it is what's called human life value, meaning what is your economic vitality value to the household? So the sum of your future earnings is a way to think about it. And a way to do that math is to take your earnings and divide it by a rate of return. So in this scenario, I use 4%. So if you take 100,000, you divide it by 4%, you get 2.5 million. What that means, and Bree, I'm gonna pick on you because I see your picture. What that means is that if, let's say you earn $100,000, if I wrote you a check today for $2.5 million, you could sit at home and do nothing for the rest of your natural life. And that $2.5 million would generate $100,000 a year back to your household, okay? So it's replacing you with a number. The problem that I find is that most people are severely underinsured for their values of what they want to have for their spouse that's left over. And I'm especially talking to my parents, I'd say my parents of children, to those individuals that have children, okay? I have dealt with in my career more times than I care to share where a spouse passes away and not enough money was left over, even though the money that was left over may have been hundreds of thousands of dollars. Because what we don't know is the emotional toll that that death will take on the family, okay? What sort of counseling do the children need? How fast can the surviving spouse go back to work? Are they emotionally ready to do those things? Okay. And I've dealt with more often than not that they're not emotionally ready. The kids aren't emotionally ready, but there's not enough money. So they don't have a choice. About 10 years ago, and a little bit longer than that, I had to tell a young lady that had 2 small children. Her husband had died in a motorcycle accident. I had to say, too bad, you got to go get a job and put your kids in daycare because your money has run out, because he only had $150,000 with life insurance in California. So her not working, 2 kids, gets $150,000, and their lifestyle was almost $100,000 a year. I said, I'm sorry, you don't have a choice. And she said, how does this happen? I can't explain that, but what I can explain to you is that you're out of money, okay? So that's the exercise I encourage you to do to figure out, okay, do you have enough and should you be getting more? Okay. So with that, let's recap the things we talked about today. Number one, create a budget. Number two, create a cash reserve, or at least create a plan for your cash reserve. Do you have enough in reserves? If you don't, create a plan to build some more. Review your current life insurance. How much do you have? Do you have enough? Should you look at some additional options? Okay, and almost any member on our team can help you with additional options for life insurance. We are what they call life insurance brokers. We're agents, we're brokers, which means we can work with any life insurance company we want. Not any, there's a few that are off limits. But what it means is we don't care whether it's Principal, Lincoln, John Hancock, we don't care. All we care is, do you have enough for your family? And then last but not least, of course, sign up for the final course of the FinLit Summer Series. Next week, we will talk about fixed and equity assets and basic things that you can do for your investment accounts right now. And then last but not least, of course, some tax strategies and estate planning strategies. So with that, as promised, I'd like to leave some time for questions. And it looks like, babe, I'm sorry, I went a little over today. But with that, let's open it up to questions. I can't find my chat group.
You can also drop any questions in the chat, or feel free to take yourself off mute.
I have a question.
Go ahead, Bree.
So when COVID and everything started, I was put on furlough. So immediately when all of this started, I called all of the companies that I was indebted to, credit cards, car, all of that, student loans, and I deferred all of my payments. But with the unemployment and the extra 600 checks, we were still sticking within our budgets, and we were able to actually put even more money into our savings. So I kept making payments on those accounts, knowing that there was no interest at the time, trying to get these down a little bit. But then, and Alicia knows, within the last week, I was officially laid off from my job, and now the additional 600 from unemployment is going to end, I think, at the end of this month.
Hopefully not, but it might.
I'm hoping not. But I want to be prepared. Can I defer them again, or defer them further and say, hey, look, I deferred them, but I was still in good standings during this time? Do you know if most companies are lenient with that? I don't know what to do now at this point.
So the short answer, what to do, is let's take some one-on-one. Let's get some one-on-one time so we can go into details. That's the short answer. Okay. The longer answer is it depends, because some banks are preparing for that. I was actually reading those articles last night. Banks set aside what's known as reserve funds for default payments and deferments, because though you may have borrowed the money from Citibank borrowed the money from Bank of America, and Bank of America borrowed it from some Saudi prince. Okay, so everybody's got their interest payments. Just because you aren't making a payment doesn't mean that Citi doesn't have to pay Bank of America and Bank of America doesn't have to pay the Saudi prince. So some of these banks are saying, hey, we think that there's going to be continued deferment. So we're setting aside capital so that we can continue to pay our debtors, so that we can give our consumers a break. Okay, but not all of them are doing it.
So some of my student loan, they were generous enough and let me defer for an entire year. But a lot of the other companies only did it for 3 months, and now I'm coming up to the point where that 3 months happened. So should I just, because I'm now officially unemployed, should I just not make payments on student loans and either save it or put it towards those other debts? Or should I try, if I can, keep paying on those student loans?
In most cases, and again, we should, like I said, let's have some one-on-one time, but in most cases, the strategy that you have is correct, with the slight change of, I would right now hold on to as much cash as possible.
Okay.
Anybody that's going to let you forbear or defer, hold on to that cash, because none of us, we don't know what we don't know.
Yeah.
Is this the first wave? Is it the second wave? Is it the third wave? What we don't know. We
I
don't
know
know.
it's frustrating because, my husband and I are pretty young. We've got 3 kids. My oldest daughter is 16. So we finally got to a point where our financials were like at a good place. We're getting ready to save for cars in college. And then this hit, and I'm just like, I just feel floored. It's really frustrating. And
Yeah.
so
Part of what we do in the financial planning process, so it's actually the crux of what we do, is to help people plan for the certainty of uncertainty, because that uncertainty always exists. When September 11th happened, none of us knew. Well, there's some arguments that there are a few small people that knew it was going to happen, or a few people that knew, but on the large scale, none of us knew it was going to happen. And we also didn't know what was going to happen the next day. One of the funniest, not funny, but one of those shocking things about, or questions I like to ask people about September 11th is, do you know how the stock market performed on September 12th? Do you think it went up or down? Okay. Well, let me ask you, on September 12th, what do you think it went up or down?
Instinctually, I want to say down, but now because you're asking it, I'm going to say up.
Okay. So here's the truth. It did nothing. It was closed. They closed the stock market for 4 days.
Okay.
So nothing happened. The stock market didn't go up or down. They kept it closed until the following Monday. When it opened the following Monday, it went down. Okay. And it went down on Tuesday, it went down on Wednesday, and then on the following Friday, it had one of the biggest rallies in history. Okay. So we really don't know what all of the effects are going to be. And then in 2002, we went into a recession. Okay. And then there was the 2008 recession. We didn't know what was going to happen each day. People were being laid off, companies were going bankrupt, et cetera. We're going through that same time period again, where we really don't know. But our role is to make sure that our clients always have a smart place to get money when they need it. Okay. And so that is why, just based on the little bit that I know, again, I'd love to know more of the details, but the little bit that I know, from what I hear, the smartest place for you to get money is going to be your bank account. Because if you give it to your creditor, you can't go back to them and say, hey, I know I gave you that $500 payment last month. Can you get it back? You're going to say, oh, no, you cannot. But you can make another payment of $500 if you like. So with a lot of our clients that have been going through what you've going to, our message has been to them, hold on to as much cash as possible. If your credit profile still looks good, you still got a 650 plus score, let's run to all these creditors and let's refinance as much as we can.
Okay, can I ask one other question?
Sure, go ahead. Yeah.
I might be saying a derogatory term right now, but previous meeting Alicia, I was a big follower of Dave Ramsey. Yes. And he doesn't believe in credit scores. And so that's kind of where my route has been. When I first became a mom, I got a credit card, maxed it out, went into crazy debt, and after I finally
you're being American. You're being
right.
American.
I'm trying. It was in survival mode. But so since then, all credit cards have been turned off. I'm just trying to make payments. How important is it to really have a credit score? Because in my mind, I'm just like, okay, I'm going to pay everything off. I'm going to be debt free, and I'm going to live this, amazing life. I'm just paying everything in cash.
Mm-hmm. So a credit score is important whenever you want to borrow new money. Okay, tell you a quick story about my credit score. When we bought this house, I had a 675. After we bought this house, a lot of things changed. My score went all the way down to like 620. I didn't care. Okay, I did not care because I wasn't trying to buy anything. But then when it was time to refinance the house, I was like, oh crap, I need to get my credit in order. So I started shuffling things around, paying things off. Next thing I know, I was back up to a 700. And then I went to go, and once it hit 700, I was like, all right, go ahead, let's apply for the house now, because I knew I was gonna get a better rate at 700 than I would have got at 620. Would they still refi for me at 620? Sure, they would have done it, but I wouldn't have got as good as a rate as I would with the 700. So Dave is right if you are living a totally cash life and you owe no one. But as long as you owe someone, there is always a chance that interest rates can improve in the future. And that's what's happened. And for interest rates to improve, in most cases, the economy has to get really shitty, okay? And so that's what happened. The economy went belly up. And so banks started lowering interest rates to encourage people to borrow. because banks only make money when they lend. So now that the economy is in the tank and interest rates are at all-time lows, if you have a good credit score right now, you're winning. Because if you have other debt, you can go refinance all your debt at astronomically low rates. We have clients every day sending us emails and text messages saying, hey, I got that 0% interest credit card. I'm gonna go ahead and transfer that other balance that was 20 or 15% or 10% to that 0%.
Okay. And you recommend doing that?
Why pay, if you have a credit card right now that's charging you 12%, but another lender is willing to give you the same amount of money at 3%, why pay 12 when you can pay 3?
But doesn't it screw up your score when you close and open up another account? Like, I guess
I never said close the other account. I just said move the balance.
Got it. Okay.
Okay.
I get
For
what you're
cars, for like cars, we have clients that we're dealing with right now that I'm saying, hey, if your car is less than 3 years old and you have at least 25, 30% equity in your car, meaning you owe less than what the car is worth, go refinance your car. And people are like, where do I go refinance? Like, just go to CapitalOne.com. I've had clients say, hey, I went to Capital One. They offered me 1.9%. I'm like, isn't that crazy? Yes, it is. Click, accept it. I'll give you another short, quick story. This happened 2 weeks ago. Client called freaking out, not because of the stock market, called freaking out because her father said, I'm sorry, honey, I can no longer pay the Parent Plus loan that we took out for you to go to school. We can't pay it anymore, especially now that your sister is in school too. Okay. So we need you to start paying part of this student loan. Excuse me, this was like 6 months ago. So they called me and said, hey, we got to start helping dad out on the student loan. That was back in March when the things first happened. Oh, no big deal. So, okay, start making $300, $400 a month. Well, then fast forward to last month, dad was like, I can't do any of this anymore because things kept changing with him financially. He's like, I can't make this payment. Okay. And they wouldn't allow him to defer it either because of the Parent Plus loan. The deferment rules are different. Okay. So the interest rate on that student loan was 6.8%. So of every payment that they were making of almost $1,200, like $500 was going to interest and $600 was going to principal. I helped them refinance that loan from 6.8% down to 4%. Okay. So now that same $1,100, $1,200 payment, $900 is going to principal and only $300 is going to interest. By them changing the loan from that Parent Plus loan and refinancing it with another company, they are going to be able to reduce their interest expense by $100,000 over the next 10 years. $100,000 is a lot of money.
Yeah.
Okay. Now, do they still have to make the payment? Yes. Okay, but their required payment, that's the other thing, their required payment went from $1,100 a month down to $8. They only have to pay $8 now. But I told them, I was like, if you can afford to pay $11, keep paying $11.
Yeah.
Because you'll pay it off that much faster. So that's the shuffling around that we're doing. Will it cause their credit score to be affected because they opened a new account? Of course, but who cares? They're cutting their interest in half and they're going to save $100,000. So what if their credit score is affected for a few months because they opened up a new account? As long as they're not trying to go buy a house or buy a car or anything else immediately thereafter, their credit score can be what it is. I don't care what my credit score is going to be in 3 months because I refinanced my house this month. In 3 months, I don't need to buy another house. My credit score falls from 700 to 650. Okay. But when I need to do something, I need my credit score to be as high as possible. And as long as I'm going to continue to owe people, I need to have a good credit score. What Dave is talking about is when you're living a totally debt-free life. Then it doesn't matter what your credit score is because you don't owe anyone. So no one's charging you any interest.
Thanks for joining us on the Money Script podcast. Be sure to check out our episodes, subscribe, follow, and give us 5 stars. Continue to send your financial questions on Twitter or Instagram at the Money Script. Go to moneyscriptwealth.com and schedule your complimentary consultation to discuss your specific goals and concerns. Financial advisory and investment management services are offered by Moneyscript Wealth Management PLLC, a registered investment advisory firm registered in the state of Texas and California and other states where exempt. The Moneyscript LLC and the Moneyscript Wealth Management PLLC and guests of the episode may have interest in the investments mentioned today. The opinions and views are expressed here are for informational purposes only. This material is educational in nature and should not be deemed as a solicitation for any specific product or service. All investments involve risk and a significant loss of principal. The Moneyscript nor Moneyscript Wealth Management offer tax or legal advice. Please consult your tax advisor or attorney for specific advice about your situation. Until next time.